Welcome, accounting boffins. You are with Ashraf Patel and the crew. Remember, we're dealing with inventory systems. We're looking at specific calculations that you need to be au fait with to fully understand and comprehend what it entails when we're working with the periodic inventory system. All right, so now if we look at our revision again, our recap, what did we say? We said that when you're dealing with the periodic inventory system, the most important component of this will be your purchases account. Remember that? Okay, and when you're dealing with the perpetual inventory system, that's the one we dealt with there, you're dealing with the trading stock account. Okay, so clearly a difference between the two, and this will become evident. This will become clearly evident to you when you see what we're going to be doing now. Right, so watch the space. With the perpetual stock system, right, and how it impacts on the accounting equation. Let's take an example. And I'm going to do it in a different way to highlight to you the difference between the two systems. Right, so this is what I'm going to do. Number one, bought merchandise for cash. Right? Clearly you can see your two accounts involved would be bank and trading stock. So you're going to debit your trading stock account. Why? It's an asset account increasing in value, therefore debited. You're going to credit your bank account. Why? It's an asset account decreasing in value, therefore credited. Just a word about the bank account. Don't take for granted that your bank is always an asset. What do I mean by that? Bank can also be a liability. In that case, your bank account will no longer be regarded as an asset, right, but a liability. However, the account debit and the account credit doesn't change, but the impact on the accounting equation will change. Okay, but this is just a side dish where we're talking about the bank account, right, where it could either be a favorable balance or an overdraft, an unfavorable balance. So very important, when you're doing the accounting equation component of it, check whether bank is favorable or unfavorable. So yes, it doesn't impact on debit and credit, but it impacts on whether bank is an asset or a liability. So we're assuming now that bank is favorable. So therefore, a debit to trading stock, a credit to bank, watch my accounting equation, my assets increase as trading stock is increasing and my asset is decreasing because bank is decreasing. Okay, so that's the perpetual inventory system. Let's take that same transaction using the periodic inventory system. Watch, now it's periodic stock system. Transaction is bought merchandise for cash, same transaction. Account debited is purchases. Note the difference. Account credited is bank, doesn't change. Notice my accounting equation. We're assuming bank is favorable, so assets minus and owner's equity minus. Why? Because purchases is an expense and it is impacting on my owner's equity. Clear? I hope you fully understand this. Right. Your liabilities remain unchanged. So now what I've done for you, I've shown you a comparison of the same transaction but treated differently using the perpetual inventory system and the periodic inventory system. Let's take another one. Here we go. We're doing bought merchandise on credit, right? Account debited will be trading stock, asset increasing in value. Account credited will be creditors control, liability increasing in value. Watch, assets plus, liabilities plus, owner's equity remains unchanged. Let's take that same transaction and apply it using the periodic system. Watch, bought merchandise on credit. Okay, here we go. Account debited is purchases. Account credited is creditors control. Notice the change. Instead of using a trading stock account, whenever we're dealing with periodic, we're using the purchases account. Effect on the accounting equation will be owner's equity minus Y. Purchases is regarded as an expense, and your liabilities increase because you are owing more money to your suppliers. So here you've seen two transactions and how they impact in terms of the accounting equation, in terms of the account debit and the account credit. Let's continue. Okay, the instruction says, compare the periodic and perpetual inventory systems by analyzing the following transactions of Ruth Traders. Goods are sold at a cost price of 100%, and example, bought goods for 2,500 by EFT. Okay, let's take the first one. Here are all my transactions. What we're going to do is we'll take each transaction as a standalone and then do the comparison so we can see what is happening. Right, first transaction. Purchase goods on credit from SW Wholesalers, 2,500 less 8% trade discount. Let's start with the perpetual first. Perpetual, we know. Account debited will be trading stock. Account credited will be creditors control. Why? Because we have purchased goods on credit. So debit trading stock, creditors control, that is using the perpetual inventory system. Let's change that now to the periodic inventory system. Watch, account debited is purchases. Your account credited obviously is creditors control. Look at your amount. Your amount is important. Goods were bought for 2,500 less the 8% trade discount. So here we go. All that we do is we say 2,500 times the 8% will give me a figure of 200 Rand. Take your 2,500 minus the 200 will give you a figure of 2,300. There we go. And that's the calculation, the explanation, 2,500 times 92%. Now, the question arises, why are we not recording the discount? Very important, guys. Whenever you're dealing with trade discount is never ever recorded. You only use the net amount. Okay? Keep that at the back of your minds. Trade discount is never ever recorded. Okay, the next one. It says here, received an invoice for 200 Rand from TT Deliverers for the transport of goods on a goods purchase from SW Wholesalers, right? Okay, let's take this transaction firstly using the perpetual inventory system. Here we go. Perpetual inventory system. Account debited is trading stock. Notice you don't keep a separate account for the delivery expense. Creditors control because it was done on credit. So clearly you can see if we take this now using the periodic inventory system. Here we go. Periodic inventory system. Account debit is carriage on purchases. A completely separate dedicated account. Okay? And a debit to that account because it's an expense. A credit to my creditors control because that's my liability. And the amount is 200 Rand. You can see what we're trying to do here for you. We're showing you the same transaction using both the perpetual system and the periodic system. So in that way, you can clearly identify how do you deal with it regarding perpetual system, how do you deal with the transaction using the periodic inventory system. Okay, next transaction. Some of the goods purchased from SW Wholesalers were badly damaged. A debit note was issued for the goods returned. Okay, here we go. Let's start with our perpetual first. In the perpetual inventory system, account debited will be creditors control. Why? Because your liability is decreasing in value. Your account credited will be trading stock. Why? Your asset is decreasing. You've returned the goods to your suppliers. Okay, now take that same transaction using the periodic inventory system. Here we go. Account debited is creditors control. Notice the same account, but your credit is creditors allowances. That is important. Okay? And clearly it was based on the previous one, so the amount was the 460 Rand, because there was a trade discount. I've explained that already, so I'm just showing you that figure that you get would be related to number one. However, what is important now, notice I'm using a new account called creditors allowances. Now, very often you could also find that in some instances the account credited here could have been your purchases account. That is also acceptable. However, it is first preferable to take it to your creditors allowances account and then transfer the total creditors allowances to your purchases account. However, if you're doing a calculation and if you want to subtract your return directly from your purchases, by all means, hunky-dory, no problem at all. Right? Okay, that transaction is done and dusted. Let's move on to the next one. Again, we're comparing our perpetual to our periodic, starting off with our perpetual. Goods sold on credit, debit debtors control, credit sales. When we're doing it with the periodic inventory system, what are we saying? Debit the debtors control, credit the sales. Right? No problem. Amount is 1,200. Now look at the next one. If you do your comparison here, right? And on this slide here, I've done something unique for you just to show you that when you're dealing with a sale, notice with the perpetual inventory system, there are two transactions, one with the selling price, one with the cost of sale, right? Whereas when you're dealing with the periodic inventory system, there's only one transaction with the selling price, right? Obviously, this calculation here dealt with the calculation when we did the cost of sales calculation, obviously using the markup that was given to us. There's my calculation to give me my calculation of my cost of sales. But what I needed to highlight here for you was the fact that in the perpetual inventory system, when we sell goods, there's two entries for perpetual, whereas periodic has one entry only the selling price. Okay. We now look at the trading account. If you're using a perpetual inventory system, in your trading account, you've got three components. What are those three components? They are your sales, your cost of sales, and obviously the profit and loss, which is your gross profit figure that you calculate. So the trading account of a perpetual inventory is pretty straightforward. Sales, cost of sales, and your profit and loss. However, when you're looking at the purchases account, when you're using a periodic inventory system, watch, there's your total that you brought forward from the previous financial year, right? Then your bank, which is your cash purchases, your credit purchases, and you may have bought goods from petty cash. How did my petty cash, how did my purchases decrease over the year? Watch, it's your donations, it's your drawings, and it's your creditors control. Remember I spoke to you about the creditors allowances? That's the return that I'm referring to. And then obviously, this is the amount that you're going to transfer from there into your trading account. Now watch this here. This is my trading account, where I'm calculating my cost of sales. Watch, opening stock, plus purchases, plus carriage on purchases, right? Then I bring in my sales component, I bring in my closing stock component, and there's my profit and loss. So in my trading account, I don't see the cost of sales as a standalone figure. Rather, all of these components together will give you the final figure, namely your profit and loss, which is your gross profit. Okay, so if we summarize this segment, we looked at the effect of transactions using both perpetual and periodic. We've shown you the accounting equation, the account debit and the account credit. We also looked at the difference between the trading account of a concern using the perpetual inventory system and one using a periodic inventory system. Okay, please make sure you can clearly distinguish between the two trading accounts. Very, very important. Let's take a quick breather and we'll be back in a jiffy.